Have you ever faced that moment of uh, information overload? Maybe it's staring down a complex topic for an upcoming exam, knowing you need to grasp it quickly, deeply, and like in a way that really sticks for application, not just memorization. That feeling where you wish someone could just, cut through the noise and give you the absolute core of what matters. Welcome to the Deep Dive, the show where we do exactly that. We sift through the dense material to get you to the critical insights you need fast. Today, we've got a very specific mission, tailored just for you, our dedicated learner. We're taking a deep dive into audit evidence, a foundational pillar in the world of auditing. This isn't just about reciting definitions. It's about building a comprehensive application-based understanding of how these critical concepts, specifically outlined in various standards on auditing or SaaS, apply in real-world scenarios and, maybe most importantly, on your upcoming case-based exam. We've taken your detailed source material, including those PDFs, 74938, BOSS 60526, CP5.pdf, 81642, BOSS 65800, CP4.pdf, and individual SAS SA500, SA501, SA505, SA510, SA530, SA550, and SA520, and distill the most crucial insights, terminology, and practical applications. Think of us as your expert guides. I'll be here to help uncover those fascinating nuggets and, ensure we make this dense material accessible and engaging.
And I'll be focused on synthesizing all that information, connecting the dots between the different standards on auditing, and offering deeper insights into the why it matters of each concept. We'll be breaking down each essay that deals with audit evidence, then tying it all together with illustrative examples and case studies straight from your material, just as you might encounter them in an exam. So let's unpack this crucial topic that forms the very foundation of an auditor's opinion. The cornerstone audit evidence, SA 500. All right, let's start at the very beginning with SA 500, which, many call the cornerstone. At its heart, what is audit evidence? Because without a clear understanding of this core concept, everything else an auditor does really loses its meaning, doesn't it?
Precisely, yeah. Audit evidence, at its core, is the information used by the auditor in arriving at the conclusions on which the auditor's opinion is based. It's comprehensive, meaning it includes information both from the accounting records, which, form the basis of the financial statements themselves, and other information that either supports or contradicts those records. This other information can come from various sources, both internal and external to the entity being audited.
So it's not just about what's recorded in the ledger, but like every shred of data that helps an auditor build a complete picture. It sounds like this evidence is literally the bedrock of an auditor's work, like the raw material for their final judgment.
It is, absolutely. Your material calls it the foundation upon which the edifice of auditing is built. The auditor gathers enough robust information to form a reasonable conclusion on the financial statements. This is key. We're not aiming for absolute certainty, which, due to the inherent limitations of an audit, is rarely possible. Instead, it's about reducing audit risk to an acceptably low level to provide that reasonable assurance.
And this isn't a one-time snapshot, is it? Is audit evidence gathering like a one-time event, or is it something that evolves throughout the audit?
It definitely evolves, yeah. Audit evidence is cumulative in nature. It's gathered throughout the entire audit process, not just at one point. It can also include information from previous audits, provided the auditor establishes its continuing relevance, or even insights from the firm's own quality control procedures applied during client acceptance and continuance. It's a dynamic, ongoing collection of data.
So how do we know if we have good evidence? It seems like quantity matters, but my gut tells me more isn't always necessarily better. Like, is piling up documents always the answer?
You're hitting on a crucial point, the quality of evidence. Yeah, absolutely right. We look at two key aspects, sufficiency and appropriateness. Sufficiency is the measure of the quantity of audit evidence. It's about having enough. The quantity needed is influenced by the auditor's assessment of risks of misstatement. Higher risks typically demand more evidence. And here's where quality comes in. If the evidence is of higher quality, less may be needed to achieve the same level of assurance. But, and this is critical, obtaining more audit evidence, however, may not compensate for its poor quality. You simply cannot pile up low-quality evidence and expect it to magically become persuasive.
So it's truly quality over quantity. Okay, how then do we define appropriate evidence? What makes it appropriate?
Appropriateness is the measure of the quality of audit evidence. That is, its relevance and its reliability. Let's break those down. Relevance refers to the logical connection with or bearing upon the purpose of the audit procedure and, where appropriate, the assertion under consideration. Think of it this way. If you're testing for overstatement in accounts payable, Examining the recorded accounts payable and vouching payments to invoices is highly relevant.
All right.
But if your goal is to test for understatement in accounts payable, that is, if there are unrecorded liabilities, that same vouching procedure isn't relevant. Instead, you'd be looking at things like subsequent disbursements, unpaid invoices, or supplier statements, which are logically connected to finding those unrecorded liabilities.
That's a great example.
Yeah.
It highlights how the same document can be relevant for one assertion but not another. So relevance is about whether the evidence actually addresses what you're trying to prove.
Yep.
Okay. What about reliability? What makes evidence reliable?
Reliability is, well, profoundly influenced by the source and nature of the evidence and the circumstances under which it's obtained. There are several generalizations about reliability that are helpful guidelines, though, like all generalizations, they can have exceptions. First, evidence is generally more reliable when obtained from independent sources outside the entity. Think of it like a detective building a case. A witness with no stake in the outcome is always more credible, right?
Yeah, absolutely.
That's why external confirmations from banks or customers often trump internal memos. Second, the reliability of internally generated evidence increases with effective related internal controls. If the client has strong controls over how internal documents are prepared and maintained, that evidence becomes more reliable.
So an invoice from a third-party supplier is inherently more reliable than one created internally by the client, unless the internal controls around that internal invoice are really robust. Understood. What else contributes to reliability?
Third, audit evidence obtained directly by the auditor is more reliable than evidence obtained indirectly or by inference. For instance, if you, the auditor, observe a physical inventory count, that's more persuasive than merely inquiring about how the count was performed. You saw it with your own eyes.
Makes sense.
Fourth, documentary form, whether paper or electronic, is generally more reliable than orally obtained evidence. A written record of a meeting is typically more trustworthy than someone's recollection of it later. And finally, original documents are more reliable than photocopies or faxes. Why? Because original documents offer stronger assurance over their preparation and maintenance. It's harder to alter an original without leaving a trace, generally.
That distinction between original and copy is so intuitive, yet, probably often overlooked. We've discussed how much evidence we need and how good it needs to be. But what form does this evidence actually take? How do auditors, categorize all this information they gather?
Audit evidence can be categorized by its nature and its source. By nature, it can be visual, like observing a physical inventory count; oral, such as discussions with management or employees; or documentary, which includes things like fixed deposit certificates or sales bills. By source, it's either internal evidence originating within the audited organization, such as sales invoices or goods received notes, or external evidence originating outside the client's organization, like purchase invoices from suppliers or direct confirmations.
Is there a general hierarchy of reliability when it comes to different sources of evidence? Is one, always preferred over another?
Yes, generally. External evidence is generally considered to be more reliable because it comes from third parties who are typically not interested in manipulating the client's accounting information. However, you must always exercise vigilance if you have any reason to doubt a third party's independence, for example, if an invoice comes from an associated concern of the client. That's a red flag. The best practice is to match internal and external evidence as far as practicable, and if external evidence isn't available, to corroborate internal evidence by seeing how various internal pieces of evidence align with each other. It's all about building a robust, interconnected case.
That makes sense. Building the picture. Now, how does an auditor actually get this evidence? What are the procedures involved in gathering it, the actual actions?
Right. Audit procedures are broadly categorized into risk assessment procedures, which help auditors understand the entity and assess risks of material misstatement, and further audit procedures. The latter category includes tests of controls, performed to evaluate the effectiveness of internal controls, and substantive procedures, which are designed to detect material misstatements directly. Substantive procedures are further broken down into tests of details and substantive analytical procedures.
Okay, let's go through the specific procedures listed in SA 500. Can you give us a brief explanation and maybe a quick example for each? That would be really helpful.
Absolutely. Let's tick them off. First, inspection. This involves examining records or documents, whether internal or external, or physically examining an asset. For instance, examining title deeds for land provides evidence of ownership and existence.
Okay, inspection. Got it.
Next, observation. This is watching a procedure being performed by others, like observing the client's staff performing their inventory count. It provides evidence about how a process is carried out at that specific time.
Seeing it happen.
Right. External confirmation. This is seeking information directly from third parties, such as customers confirming their outstanding balances or banks confirming loan details. We'll talk more about this with SA 505.
Okay.
Recalculation. This means checking the mathematical accuracy of documents or records, which can be done manually or electronically. A common example is verifying foreign currency conversion into rupees to ensure mathematical correctness.
Checking the math. Simple enough.
Reperformance. This is when the auditor independently executes procedures or controls that were originally performed by the entity. For instance, reperforming a bank reconciliation or the aging of accounts receivable to verify the client's work.
Doing it yourself to check their work.
Analytical procedures. These involve evaluating financial information by studying plausible relationships among both financial and non-financial data and investigating fluctuations that are inconsistent with expectations. We'll dive much deeper into this in SA 520, as it's a powerful tool.
Okay, looking forward to that one.
And finally, inquiry. This is seeking information from knowledgeable persons, both internal and external to the entity. It's used extensively. However, it's crucial to remember that inquiry alone ordinarily does not provide sufficient audit evidence for the absence of a material misstatement or the operating effectiveness of controls. It usually needs corroboration from other procedures.
Right, so inquiry gets the conversation started, but you almost always need more to build a strong case. Okay, one more important area under SA 500 involves working with experts. What's the auditor's responsibility when dealing with information from a management expert, say a property valuer or an actuary?
That's a great point. A management's expert is an individual or organization with expertise in a field other than accounting or auditing, whose work the entity uses to assist in preparing the financial statements. The auditor has a clear responsibility here. They must evaluate the competence, capabilities, and objectivity of that expert. You need to understand their qualifications, their professional standing, and any potential biases they might have. After all, their work is influencing the financial statements you're auditing.
Yeah, it's not just taking their word for it then, especially if they're on management's payroll, right? That objectivity piece seems key.
Exactly. You also need to obtain an understanding of the work the expert performed, including its scope, objectives, and the assumptions and methods they used. Finally, you must evaluate the appropriateness of that expert's work as audit evidence for the relevant financial statement assertion. This means determining if the expert's findings are actually suitable for your audit purposes. Factors to consider include the nature and complexity of the matter, the risks of material misstatement, the availability of alternative evidence, whether the expert is employed internally or externally, and the extent of management's influence over their work and even your own prior experience with that expert. It's a comprehensive evaluation.
Specific considerations for selected items. SA 501.
That's a very clear overview of SA 500, setting the stage for all audit evidence. Now, let's move to SA 501, which hones in on specific considerations for selected items. What specific areas does the standard on auditing require special attention for? Sounds like these are maybe common problem areas.
Yeah, you could say that. SA 501 deals with obtaining sufficient appropriate audit evidence for 3 specific, often immaterial areas: inventory, litigation, and claims involving the entity, and segment information. The auditor's objective is to obtain evidence on the existence and condition of inventory, the completeness of litigation and claims, and the presentation and disclosure of segment information in accordance with the applicable financial reporting framework.
Let's start with inventory. It's typically a significant asset on the balance sheet, right? What's the primary procedure for it? What's the gold standard?
If inventory is material to the financial statements, the auditor must obtain evidence for its existence and condition primarily by attendance at physical inventory counting. This isn't just showing up, though. It involves several key actions: evaluating management's instructions and procedures for the count, observing management's count procedures in action to ensure they're followed, inspecting the inventory itself for condition and signs of damage, obsolescence, etc., and performing test counts by selecting items and verifying their quantities against the count records.
So you're really getting hands-on. What if the count isn't done on the financial statement date, say a month before or after the year end? Does that complicate things?
It does require extra steps. If the inventory counting is conducted at a date other than the financial statement's date, the auditor needs to perform additional procedures with respect to intervening transactions. That is, the movements of inventory, the ins and outs between the count date and the year-end date. This ensures that the count results can be accurately extrapolated or rolled forward backward to the financial statement date.
And what if attending the physical count is genuinely impracticable? Like if it's in a remote, dangerous location, not just, inconvenient or costly, can an auditor just skip it?
That's an important distinction. Impracticable refers to situations like genuine threats to the safety of the auditor, or maybe the location is completely inaccessible. It's not just about general inconvenience, time constraints, or cost. You can't use those as excuses. If attendance is genuinely impracticable, the auditor must perform alternative audit procedures to obtain sufficient appropriate evidence regarding the existence and condition of inventory. An example might be inspecting documentation of subsequent sales of specific inventory items acquired before the count, or inspecting third-party warehouse receipts and reports. However, if it's not possible to obtain sufficient appropriate evidence through any alternative procedures, maybe the records are terrible too, then the auditor shall modify the opinion in the auditor's report as per SA 705 due to a scope limitation. You can't give a clean opinion if you can't verify a material item.
That makes sense. And what about inventory held by a third party, like goods on consignment or sitting in a public warehouse? How do you verify that?
Good question. If inventory is held by a third party and is material, the auditor should first request confirmation from third party regarding the quantities and condition of inventory held on the entity's behalf. Additionally, depending on the assessed risk and materiality, the auditor should perform inspection and other procedures, such as inspecting the entity's records of goods sent to and received from the third party, tracing those movements to supporting documents like challens or e-way bills. This corroboration is key, especially if you have any doubts about the third party themselves.
Okay, that covers inventory pretty well. Next up in SA 501, litigation and claims. This sounds like an area that could uncover some serious financial risks, maybe even things management isn't eager to talk about. How does an auditor go about identifying these?
You're right, it can be a high-risk area and requires careful handling. The auditor must perform audit procedures designed to identify litigation and claims that may indicate a risk of material misstatement. This includes inquiry of management and, if applicable, the entity's in-house legal counsel. Also, reviewing minutes of meetings of those charged with governance, like the board, and correspondence between the entity and its external legal counsel. And finally, reviewing legal expense accounts can often reveal payments to lawyers that might signal undisclosed claims or ongoing disputes. It's like following the money trail.
So, if those initial steps hint at a significant risk of a material misstatement, maybe a large claim is mentioned, or management seems evasive, what's the next critical step? You probably need more than just management's word, right?
Absolutely. If the auditor assesses a risk of material misstatement regarding identified litigation or claims, or if other procedures suggest material claims may exist, the auditor must seek direct communication with the entity's external legal counsel. The procedure for this is very specific. It's a letter of inquiry prepared by management and sent by the auditor. This letter should list known claims, management's assessment of their potential outcome and financial implications, and crucially ask the lawyer to confirm the reasonableness of these assessments or provide further information if the list is incomplete or assessments seem off. This process ensures management is aware of and agrees to the communication. It's their lawyer, after all, while the auditor controls the sending and receiving of the response to maintain independence.
Okay, that control seems vital. And what if the lawyer is uncooperative, or even worse, management refuses to allow this direct communication? That sounds like a big red flag, a major problem.
It absolutely is. If the auditor is unable to communicate with the external legal counsel, perhaps because management refuses permission or the counsel is prohibited from responding due to legal reasons, and the auditor cannot obtain sufficient appropriate audit evidence through alternative procedures, which might be very difficult in this area, then the auditor shall modify the opinion as per SA 705. This represents a significant scope limitation, directly impacting the auditor's ability to express an unqualified opinion on the financial statements. You can't just ignore a potential unquantified liability.
Beyond direct communication with the lawyer, is there any other evidence required for litigation and claims, like a final sign-off from management?
Yes, there is. The auditor must obtain written representation that all known actual or possible litigation and claims that should be considered when preparing the financial statements have been disclosed to the auditor and appropriately accounted for or disclosed in accordance with the applicable financial reporting framework. This is a crucial formal confirmation from management about the completeness of their disclosures, basically putting it in writing.
Lastly, for SA 501, What about segment information? It's often complex for larger, diversified companies, isn't it? How does the auditor tackle that?
For segment information, the auditor's objective is to obtain sufficient appropriate audit evidence regarding its presentation and disclosure in accordance with the applicable financial reporting framework. Procedures involve obtaining an understanding of management's methods for determining segment information, how they define segments, allocate revenues and costs, etc. Then, evaluating whether these methods are likely to lead to compliant disclosure and testing their application. Additionally, performing analytical procedures or other appropriate audit procedures to corroborate the segment data seems reasonable in the context of the financial statements as a whole. The auditor isn't expected to perform procedures necessary to express an opinion on the segment information on a standalone basis, only in relation to the overall financial statements.
Getting confirmation, external confirmations, SA 505.
That's a clear breakdown of how to approach these specific high-stakes items in SA 501. Now, let's talk about a highly effective method for gathering evidence we touched on earlier, external confirmations, guided by SA 505. What's the main idea behind using these, and why are they so highly regarded in auditing?
Right. SA 505 provides guidance on how the auditor uses external confirmation procedures to obtain relevant and reliable audit evidence. The key reason these are so valuable, as we discussed earlier with SA 500, is that they represent audit evidence obtained directly by the auditor from confirming parties. This makes them often significantly more reliable than evidence generated internally by the entity. This direct communication from an independent source really strengthens the audit evidence. It's like getting a direct, unbiased statement from a third party about balances or transactions.
So what are the different types of confirmation requests an auditor can use? I think I've heard positive and negative ones.
That's correct. There are two main types. First, the positive confirmation request. This requires the confirming party to respond to the auditor in all cases, either by agreeing with the given information, like an account balance, or by providing the requested information if it differs. A common variation to enhance reliability is the blank confirmation request, where the amount or other information is omitted and the confirming party is asked to fill it in. While this yields higher reliability by forcing the recipient to actively verify, it can sometimes result in a lower response rate because it's more work for them.
Okay, so positive means respond no matter what.
Yeah.
What about the negative ones? You mentioned they seem inherently riskier. What are the major pitfalls there? Why wouldn't an auditor always choose a positive one? Seems safer.
You're absolutely right to be cautious about negative confirmations. This type asks for a response only if the confirming party disagrees with the information provided in the request. The inherent weakness here is precisely what you hinted at. A failure to respond does not explicitly confirm receipt by the intended party or the accuracy of the information. They might have simply ignored it, or it got lost, or they didn't check it properly. Silence doesn't equal agreement here. Because of this critical limitation, negative confirmations provide less persuasive evidence than positive ones and are used as the sole substantive audit procedure only under very restrictive conditions.
What are those restrictive conditions? It sounds like you wouldn't use them unless everything else points to an extremely low-risk scenario, like really low risk.
Exactly. All four conditions must be met concurrently for negative confirmations to be the only procedure used. 1. The auditor has assessed the risk of material misstatement as low and obtained sufficient appropriate evidence regarding the operating effectiveness of relevant controls. Strong controls are key. 2. The population of items subject to negative confirmation procedures comprises a large number of small, homogeneous transactions or balances. Think lots of small, similar customer balances. 3. A very low exception rate is expected, meaning you genuinely don't anticipate many disagreements or errors in the first place based on past experience or other tests. 4. The auditor is not aware of circumstances or conditions that would cause recipients of negative confirmation requests to disregard such requests. For instance, maybe the industry is known for ignoring these, or there are disputes making customers unlikely to respond. If any of these conditions aren't met, negative confirmations alone are insufficient for providing persuasive evidence. You'd need other procedures too.
That makes perfect sense. It reinforces that reliability point. It also makes sense that the auditor needs to maintain tight control over this whole confirmation process to ensure the integrity of the evidence. How is that achieved in practice? Who does what?
The auditor must maintain strict control over external confirmation requests. This includes determining the information to be confirmed or requested, selecting the appropriate confirming parties who actually knows the information, designing the confirmation requests, including checking that requests are properly addressed and contain return information for responses to be sent directly to the auditor, and sending the requests, including follow-up requests when applicable, to the confirming parties. Most crucially, ensuring that the responses come directly back to the auditor, not routed through the client. This directness safeguards reliability by minimizing opportunities for client intervention or alteration of the responses.
Okay, that control is paramount. Now, what happens if there's a doubt about the reliability of a response? Perhaps it looks suspicious. Maybe it came via email from a weird address. Or if someone just doesn't respond to a positive confirmation request at all.
Good questions. If the auditor identifies factors that give rise to doubts about the reliability of the response, for example, if it was received indirectly, like forwarded by the client, or appears not to come from the intended confirming party, or if there are electronic risks, like maybe it's easily forgeable, the auditor shall obtain further audit evidence to resolve those doubts. You can't just accept a dodgy-looking response. If, after getting more evidence, the response is determined to be unreliable, the auditor must then evaluate the implications on the assessment of the relevant risks of material misstatement, including the risk of fraud, and consider modifying planned audit procedures. An unreliable response could signal a deeper problem.
And non-response. If you send a positive request and just hear crickets.
For a non-response to a positive confirmation request, when that confirmation was deemed necessary to obtain sufficient appropriate evidence, the auditor shall perform alternative audit procedures. You still need the evidence somehow. For accounts receivable, alternative procedures could involve examining specific subsequent cash receipts that relate to that balance, reviewing shipping documentation, or looking at sales agreements near the period end. For accounts payable, it might mean examining subsequent cash disbursements or correspondence from third parties, or goods received notes to see if the liability existed and was subsequently settled.
That makes sense. You find another way to verify it. But what if management outright refuses to let the auditor send a confirmation request? That sounds like a significant red flag. That would put any auditor on edge, surely.
It absolutely is a significant issue and a major red flag. If management refuses to allow the auditor to send a confirmation request, the auditor must 1. First, inquire about management's reasons for the refusal and seek audit evidence as to their validity and reasonableness. You need to understand why they're saying no. Is it a legitimate reason or are they hiding something? 2. Second, evaluate the implications of management's refusal on the auditor's assessment of the relevant risks of material misstatement, including the risk of fraud, because such a refusal could indeed indicate a fraud risk factor or an attempt to conceal misstatements. 3. Third, perform alternative audit procedures designed to obtain the relevant and reliable audit evidence that would have been provided by the confirmation. 4. Finally, if the auditor concludes that management's refusal is unreasonable, or if they are unable to obtain the necessary evidence through alternative procedures, the auditor shall communicate with those charged with governance, like the audit committee, as per SA 260. And then, critically, they must determine the implications for the audit and the auditor's opinion in accordance with SA 705. This often leads to a scope limitation and a modified opinion.
Starting fresh initial audit engagements, SA 510.
That's a lot to consider for confirmations, especially when you think about the risks involved with refusals or non-responses. Let's shift gears now to SA 510, which focuses on initial audit engagements, opening balances. What exactly defines an initial audit engagement, and why does it require such special attention? I imagine starting fresh with a new client always has its unique challenges, right? Getting up to speed.
You're right. It's a unique challenge and carries specific risks. An initial audit engagement is defined as one where either the financial statements for the prior period were not audited at all, or they were audited by a predecessor auditor, i.e., a different audit firm. The objective of SA 510 in such a scenario is twofold. 1. To obtain sufficient appropriate audit evidence regarding whether the opening balances contain misstatements that materially affect the current period's financial statements. You need to know if you're starting from a correct baseline. 2. And to determine whether appropriate accounting policies reflected in the opening balances have been consistently applied in the current period, and if there are any changes in policies, that they are properly accounted for and adequately presented and disclosed. Basically, ensuring a clean and reliable starting line for the current period's audit.
So it's really about making sure the very beginning of the period you're auditing is accurate and properly stated, both numbers and policies. What exactly are opening balances in this context? Is it just like cash and inventory?
It's broader than that. Opening balances refer to those account balances that exist at the beginning of the period. They are based upon the closing balances of the prior period and reflect the cumulative effects of transactions and events from previous periods and the accounting policies applied in those prior periods. This also includes matters requiring disclosure that existed at the beginning of the period, such as contingencies and commitments, which might still be relevant and require disclosure in the current period's statements.
So what audit procedures does the new auditor perform to get comfortable with these opening balances? Even if the prior year was audited by someone else, does the new auditor still have to do some work? You can't just take the old auditor's word for it entirely.
Absolutely not. The new auditor has their own responsibility. Their procedures include several steps. Firstly, they read the most recent financial statements and the predecessor auditor's report, if one exists, for any relevant information about those opening balances, accounting policies, and any modifications in the prior report. Secondly, they need to perform procedures to determine whether the prior period's closing balances have been correctly brought forward to the current period, or if any necessary restatements or adjustments have been properly accounted for and disclosed as prior period items. Thirdly, they need to determine whether the opening balances reflect the application of appropriate accounting policies. Are the policies used consistent with the framework? And then they perform specific audit procedures on the opening balances themselves. If the prior year's financial statements were audited, the current auditor can gain some evidence by reviewing the predecessor auditor's working papers if access is granted. However, reliance isn't automatic. The current auditor must still perform procedures to corroborate the opening balances, especially if misstatements are indicated or concerns arise about the predecessor's work. A critical area often requiring specific attention is inventory. While current period audit procedures on the closing inventory balance provide some evidence about cost, they offer little audit evidence regarding inventory on hand at the beginning of the period concerning existence and condition. Therefore, additional audit procedures may be necessary. This could involve observing a current physical inventory count and reconciling it back to the opening quantities, rollback procedures, performing procedures on the valuation of the opening inventory items, and performing tests on gross profit and cutoff procedures to check for consistency and accuracy relating to the opening balances.
Okay, so inventory is often a special case. What if, after all these procedures, the auditor finds misstatements in the opening balances? What happens then?
If the auditor obtains audit evidence that the opening balances contain misstatements that could materially affect the current period's financial statements, they, quote, shall perform such additional audit procedures as are appropriate in the circumstances to determine the full effect on the current period's financials. If these misstatements are confirmed, the auditor communicates them with management and those charged with governance, urging them to correct the misstatements and their impact on the current period's figures.
Beyond just the numbers, there's also the consistency of accounting policies, right? You mentioned that. You want to make sure the company isn't suddenly changing how it accounts for things without good reason or disclosure.
Yes, consistency is absolutely key for comparability and understanding financial trends. The auditor needs to obtain sufficient, appropriate evidence that the accounting policies reflected in the opening balances have been consistently applied in the current period's financial statements. If there have been changes in accounting policies, they must ensure these changes are properly accounted for and adequately presented and disclosed in accordance with the applicable financial reporting framework. This ensures transparency for financial statement users about how results are being measured.
And what are the implications for the auditor's report and opinion if there are issues with opening balances or policy consistency? This is directly relevant for our listeners' exams, where reporting consequences are often tested. What kind of opinion modification might occur?
This is indeed critical for reporting. And SA 510 links directly to SA 705, which deals with modified opinions. First, if the auditor is unable to obtain sufficient appropriate audit evidence regarding the opening balances, perhaps because the prior period was unaudited and records are poor, or the predecessor auditor's work isn't available or reliable, a qualified opinion or disclaimer of opinion is required in the auditor's report, depending on the pervasiveness of the inability to get evidence. This indicates a scope limitation. Second, if the auditor concludes that the opening balances contain a material misstatement that affects the current period's financial statements, and this misstatement is not properly accounted for, presented, or disclosed, a qualified opinion or an adverse opinion is required. This is because the financial statements are materially misstated. Third, similarly, if accounting policies reflected in opening balances are not consistently applied in the current period, or if changes in policies are not properly accounted for or adequately presented or disclosed, a qualified opinion or an adverse opinion is required. This impacts the true and fair view and comparability. Finally, if the predecessor auditor's opinion on the prior period financial statements included a modification, example, qualified, adverse, or disclaimer, and the matter giving rise to that modification remains relevant and material to the current period's financial statements. The current auditor must also modify their current period report, referencing the prior issue. This ensures continuity and appropriate disclosure of prior unresolved issues that still impact the current financial picture.
Selecting with precision audit sampling, SA 530.
So that covers initial engagements and the importance of a clean start. Very clear reporting implications there. Now let's talk about a widely used technique to be efficient, especially with large volumes of data. Audit sampling, governed by SA 530. As a learner, I might wonder, why don't auditors just check 100% of everything? My inner perfectionist wants to verify every single transaction. Seems safer? No.
That's a perfectly natural inclination, and in theory, 100% checking sounds like the ultimate assurance. But in practice, for many audits, traditional 100% checking can be economically wasteful and simply not feasible given the sheer volume of transactions in many modern entities. Auditing also acknowledges that effective internal controls, when present, can prevent and detect many errors and frauds, making extensive, routine 100% checking less necessary for achieving reasonable assurance. The core idea of sampling is to apply audit procedures to less than 100% of items within a population of audit relevance, but to do so in such a way that the sample selected is expected to be representative of the population, thereby providing a reasonable basis for the auditor to draw conclusions about the entire population. It complements SA 500, which identifies audit sampling as one means of selecting items for testing.
Okay, so efficiency is a big driver. Can you give us the formal definition of audit sampling then? What makes it sampling versus just picking a few items?
Certainly. Audit sampling, or sampling, is formally defined as the application of audit procedures to less than 100% of items within a population of audit relevance, such that all sampling units have a chance of selection. The key phrase there is all sampling units have a chance of selection. This is crucial. It's this characteristic that allows the auditor, in theory, to extrapolate the results from the sample back to the entire population. If not all items have a chance, it's not audit sampling in the technical sense, it's something else, like selective testing.
Right, that chance of selection is the differentiator. So if you're not checking everything, there's always a risk that your sample doesn't perfectly represent the whole population, purely by chance. What is that specific risk called, and what are the practical implications if your sample leads you to the wrong conclusion?
That inherent risk is called sampling risk. It's defined as the risk that the auditor's conclusion based on a sample may be different from the conclusion if the entire population were subjected to the same audit procedure. It's the risk of drawing an incorrect conclusion because you tested only a sample. Your material outlines two types of erroneous conclusions that can arise from sampling risk, depending on whether you're performing test controls or tests of details. One, in a test of controls, you might erroneously conclude that controls are less effective than they actually are. Risk of under-reliance. This often leads to more work for the auditor, as they might then unnecessarily increase the extent of substantive procedures affecting audit efficiency. Or, conversely, you might conclude controls are more effective than they are, risk of over-reliance, which affects audit effectiveness and increases the risk of not detecting a material misstatement. 2. Similarly, in a test of details, you might erroneously conclude that a material misstatement does not exist when in fact it does. Risk of incorrect acceptance. This is the big danger as it affects audit effectiveness. Or you might conclude a material misstatement exists when it doesn't. Risk of incorrect rejection. This latter type again affects audit efficiency, leading to unnecessary additional work.
Okay, so sampling risk can impact both how effective the audit is and how efficient it is. When it comes to the approaches, are there different ways to select a sample? I hear about statistical versus non-statistical sampling. And is it true that statistical sampling always requires a larger sample size, or is that a myth? Seems like statistical would mean bigger.
That's a very common misconception, and yeah, it's definitely a myth. Sample size is not a valid criterion to distinguish between statistical and non-statistical approaches. The real determining factor is the methodology used for selection and, crucially, for evaluating the results. Statistical sampling has two key characteristics. First, random selection of the sample items. Second, the use of probability theory to evaluate sample results, including measurement of sampling risk characteristics. It's considered more scientific and objective because it allows the auditor to quantitatively measure and control sampling risk, giving you a statistical confidence level about your conclusions. Non-statistical sampling, often called judgmental sampling, is where the auditor uses professional judgment rather than probability theory to select the sample items and evaluate the results. Selection might be haphazard or based on specific criteria, but it doesn't allow for the statistical measurement of sampling risk. The criticism here is that it's neither objective nor scientific due to the potential for unintentional personal bias in selection or evaluation. However, regardless of the approach chosen, statistical or non-statistical, the goal is the same. The sample must be representative of the population. It should be selected in a way that is expected to mirror the characteristics of the whole population, so that conclusions drawn from the sample are likely to be valid for the population itself.
Okay, so the core difference is the use of probability theory and random selection, not necessarily size. Once an auditor decides to sample, how do they actually design the sample, determine its size, and select the items? And it sounds like there's a lot of careful thought that goes into this, not just grabbing a random handful.
Indeed. It requires careful planning. When designing an audit sample, the auditor must first consider the purpose of the audit procedure and the characteristics of the population from which the sample will be drawn. What are you trying to achieve with this test? What is the nature of the items you're looking at? Then, the auditor shall determine a sample size sufficient to reduce sampling risk to an acceptably low level. A key principle here is that the lower the risk the auditor is willing to accept, the greater the sample size will need to be. So if you need very high confidence, low acceptable risk, you'll need a larger sample. Finally, the auditor shall select items for the sample in such a way that each sampling unit in the population has a chance of selection. This goes back to the definition ensuring representativeness and avoiding bias.
What are some of the practical factors that influence sample size for both tests of controls and tests of details? I imagine it's not a one-size-fits-all formula. It must depend on the situation.
You're absolutely right. Many factors come into play and interact. For tests of controls. The auditor's assessment of the expected rate of deviation based on understanding controls or prior experience. If a high deviation rate is expected, testing controls might not even be efficient. But if you do test, a higher expected rate might require a larger sample to confirm your assessment. For tests of controls, the tolerable rate of deviation set by the auditor. A lower tolerable rate requires a larger sample. For tests of controls, the desired level of assurance or confidence level that the actual deviation rate isn't higher than the tolerable rate. Higher desired assurance means a larger sample size. For tests of details, the assessed risk of material misstatement at the assertion level, considering both inherent and control risk. A higher assessed risk requires a larger sample size because you need more persuasive evidence. The use of other substantive procedures directed at the same assertion. If the auditor relies more on other procedures, like analytical procedures, a smaller sample size may suffice for the test of details. Tolerable misstatement for the population. This is the maximum monetary misstatement the auditor is willing to accept in the population without modifying their opinion. A lower tolerable misstatement, less room for error, means a larger sample size is needed. The expected amount of misstatement in the population. If the auditor expects to find a higher amount or frequency of misstatement, a larger sample size is needed to make a reasonable estimate of the actual misstatement or to confirm the expectation. Stratification of the population when appropriate. Dividing the population into subgroups can sometimes reduce the required sample size by focusing effort.
Those are a lot of interconnected factors that really emphasizes the judgment involved. Now, about the actual selection methods, once you know the size, how do you pick the items in a way that gives everything a chance and minimizes bias? You mentioned random selection for statistical. Well, what are the main ways?
There are several principal methods auditors use for selecting samples. Random sampling. This ensures that all items have a known and usually equal chance of selection. This is the cornerstone of statistical sampling. Methods include using random number generators or tables, simple random sampling, which is suitable for homogeneous populations. Stratified sampling. This involves dividing the population into discrete subpopulations or strata, which have identifying characteristics, example, high-value items versus low-value items, and then applying sampling techniques to each stratum independently. This allows more audit effort to be directed efficiently to high-value or high-risk items, often reducing the overall sample size compared to simple random sampling. Systematic sampling. This involves selecting items using a constant interval between selections after determining a random starting point, example, selecting every 50th invoice. You need to ensure the sampling interval doesn't align with a particular pattern in the population which could bias the sample. Using multiple random starts can mitigate this risk. Monetary unit sampling, MUS, or value-weighted selection. This is a type of statistical sampling technique that uses the individual monetary unit, like a dollar or rupee, as the sampling unit. It automatically results in larger value items having a proportionally higher chance of being selected, effectively stratifying the population by value and focusing audit effort efficiently. Haphazard sampling. This is a non-statistical method where the auditor selects the sample without following a structured technique, attempting to choose items without any conscious bias or predictability. However, it's difficult to demonstrate lack of bias, and it's not appropriate when using statistical sampling because it doesn't allow for the objective measurement of sampling risk. Block selection. This involves selecting a block or blocks of contiguous items from within the population, alter all transactions for a specific week. The main drawback here is the high potential for non-representativeness, as items in a sequence often share characteristics not found elsewhere. It's rarely an appropriate method unless other procedures are also used.
Okay, quite a few options there, each with pros and cons. Finally, after all this design and selection, how does the auditor evaluate the results from this sample? You can't just tally up the errors and project linearly, I'd imagine, especially if you find something odd.
No, absolutely not. Evaluation is critical. When deviations in tests of controls or misstatements in tests of details are identified in the sample, the auditor must first investigate the nature and causes of them. Are they anomalies? Are they systemic? Do they indicate errors or potential fraud? Understanding the nature of the errors is crucial because a common feature among identified errors might indicate a specific breakdown in internal controls or a pattern suggesting intentional manipulation. The auditor then projects the misstatements found in the sample to the entire population to estimate the likely misstatement in the population. They then evaluate whether the projected misstatement, plus any anomalies, exceeds the tolerable misstatement. They also need to evaluate the qualitative aspects of the errors found, especially if they indicate fraud, which requires revisiting overall risk assessments and potentially expanding audit procedures significantly.
Connected enterprises, related parties, SA 550.
That deep dive into sampling really highlights the blend of, well, statistical thinking and professional judgment in auditing. Now let's move to SA 550, which deals with related parties. This feels like an area ripe for, shall we say, unusual transactions, maybe even engineered ones. What's the scope and objective of this standard? Why the special focus?
You're right to flag it as a potentially sensitive and high-risk area. SA 550 deals with the auditor's responsibilities regarding related party relationships and transactions, specifically focusing on the identification and assessment of the risks of material misstatement associated with them. It recognizes that related party relationships can present greater opportunities for collusion, concealment, or manipulation. It also expands on how other key SAs, like SA 315, Risk Assessment, SA 330, Responding to Assessed Risks, and particularly SA 240, Fraud, are to be applied in the specific context of related parties. It's a critical area demanding heightened professional skepticism.
So what exactly defines a related party? Is it just about common ownership or family ties? Or is it wider than that?
The definition is often based on the applicable financial reporting framework, like accounting standards or INAS in India. But SA 550 often takes a broader view for risk assessment purposes. Typically, it includes parties that have the ability to control or be controlled by the entity, or exercise significant influence over the entity, or entities that are under common control or common significant influence. Common indicators include common controlling ownership, entities controlled by close family members of key management, or entities where key management personnel hold significant influence. An important exception noted in your material for auditors is regarding state-controlled entities, government-related entities. They're generally not considered related for the purposes of SA 550 unless they engage in significant transactions with the entity or share resources to a significant extent with each other.
Can you elaborate a bit on control versus significant influence? What's the practical difference for an auditor, especially when looking at risks? Does it change how you approach things?
Yes, the distinction matters for risk assessment. Control generally implies the power to govern the financial and operating policies of an entity so as to obtain benefits from its activities. Think direct decision-making power, like a parent company over a subsidiary. Significant influence is usually defined as the power to participate in the financial and operating policy decisions, but is not control or joint control over those policies. It's more of a strong advisory role or the ability to affect decisions, perhaps through board representation or major contracts. This distinction matters because the degree of influence affects the potential for and nature of risk. Your material also highlights the concept of dominant influence, where a related party might exert influence through force or duress, overriding normal governance. This is a significant indicator when identifying risks of material misstatement due to fraud, as it suggests one party can largely dictate terms and potentially bypass controls.
And what about those tricky special purpose entities or SDVs? They seem to crop up in a lot of complex financial structures, often linked to related parties, right? How do they fit in here?
SPVs are certainly worth mentioning and are often linked to related parties. An SPV, sometimes called a special purpose vehicle or variable interest entity, can be considered a related party even if the reporting entity owns little or none of its equity, if the entity in substance controls it. These entities are often designed for specific, narrow purposes, like holding assets or conducting specific transactions, and their structure can sometimes obscure underlying control relationships or economic substance, making them a common vehicle for complex, off-balance sheet, or potentially manipulative related party transactions. Auditors need to look beyond just legal ownership.
So are all related party transactions inherently risky or suspicious then? Should alarm bells ring every time you see one, or is it more nuanced?
It's definitely nuanced. Many related party transactions are in the normal course of business and may carry no higher risk of material misstatement of the financial statements than similar transactions with unrelated parties. For example, routine sales between group companies and established transfer prices. However, the nature of some related party relationships and the structure of certain transactions can give rise to higher risks of material misstatement compared to transactions with unrelated third parties.
What makes those specific transactions higher risk then? What should an auditor be looking out for? What are the characteristics that make them risky?
Several factors contribute to this heightened risk potential. First, related parties may operate through an extensive and complex range of relationships and structures, like groups with many subsidiaries, SPVs, partnerships, increasing transaction complexity and making them harder to understand and trace. Second, internal information systems may be ineffective at identifying or summarizing all related party transactions and outstanding balances accurately, especially if they are non-standard or arranged informally. Third, and crucially, related party transactions may not be conducted under normal market terms and conditions. For example, transactions might involve unusual pricing, credit terms, or even no exchange of consideration, like services provided for free. This lack of clear market benchmarks or substance is a huge red flag.
Okay, those are clear risk indicators. Given these complexities and potential risks, what are the auditor's key responsibilities when it comes to auditing related parties? What must they do?
First and foremost, maintaining professional skepticism is particularly important throughout the audit in relation to related parties. This is due to the inherent potential for undisclosed relationships and transactions, or for transactions being structured to conceal their true substance or to commit fraud. The auditor must perform procedures to understand the entity's related party relationships and transactions. This involves active inquiry of management regarding the identity of the entity's related parties, including any changes from the prior period, the nature of the relationships between them, and the types and purpose of the transactions that occurred with these parties during the period. The auditor also needs to obtain an understanding of the controls that management has established to identify, account for, and disclose related party relationships and transactions in accordance with the financial reporting framework. Are there controls, and are they effective?
What if the auditor uncovers a previously unidentified or undisclosed related party or a significant related party transaction during the audit, maybe through reading board minutes or scanning supplier lists? That sounds like a major finding that would change the audit significantly, wouldn't it?
It is, and it immediately triggers a specific set of rigorous procedures. If previously unidentified or undisclosed related parties or significant related party transactions are found, the auditor must 1. Promptly communicate the relevant information to the other members of the engagement team to ensure everyone is aware of the new risk and can consider its implications. 2. Where the financial reporting framework establishes related party requirements, request management to identify all transactions with the newly identified related parties for the auditor to evaluate further. 3. Perform appropriate substantive audit procedures relating to these newly identified relationships and transactions. 4. Reconsider the risk that other unidentified or undisclosed related parties or significant related party transactions may exist and perform additional procedures as necessary. If management missed one, maybe they missed others. 5. And critically, if the non-disclosure by management appears intentional and therefore potentially indicative of a risk of material misstatement due to fraud, the auditor must evaluate the implications for the audit, with SA 240 fraud becoming highly relevant. This could profoundly impact the perceived reliability of management's other representations and the entire audit strategy.
That's a huge implication. Intentional non-disclosure is serious. What about those significant related party transactions outside the entity's normal course of business? These are definitely the ones that pique an auditor's interest the most, aren't they? The weird one-off deals.
They absolutely are, and your material explicitly states that these are treated as giving rise to significant risks. For these specific transactions, the auditor must perform detailed procedures. They need to inspect the underlying contracts or agreements, if any, and evaluate the business rationale, or lack thereof, behind the transactions. This means assessing if the transaction seems designed to engage in fraudulent financial reporting or to conceal misappropriation of assets. Is it overly complex? Does it have unusual terms of trade? Does it involve previously unidentified related parties? Does it lack an apparent logical business reason for its occurrence? Is it a legitimate business deal, or is it something else? Evaluate if the terms of the transactions are consistent with management's explanations. Do the explanations make sense given the terms? Evaluate whether the transactions have been properly accounted for and disclosed in the financial statements according to the framework. And obtain sufficient appropriate audit evidence that the transactions were appropriately authorized and approved by management and, where applicable, those charged with governance. Was proper governance followed?
But confirming whether these transactions are truly at arm's length, that is, on terms equivalent to those that would prevail in a transaction with unrelated, independent parties must be incredibly difficult. I imagine it's hard to find a comparable transaction sometimes.
It is indeed a crucial insight and a major challenge. Management is responsible for substantiating any assertion that a related party transaction was conducted on terms equivalent to those prevailing in an arm's length transaction. However, auditors face practical difficulties that limit the auditor's ability to obtain sufficient appropriate audit evidence to conclusively support or refute such an assertion. Even if the price looks market-based, other terms like credit periods, guarantees, delivery schedules, or hidden clauses might not be equivalent. This inherent opaqueness and difficulty in comparison is why auditors treat these assertions and the underlying transactions with such high skepticism. Their prime areas for hidden risks or even fraud is you can't easily verify the arm's length claim.
This definitely sounds like a prime area where fraud could occur. How do related parties link specifically to fraud risk factors, especially when that concept of dominant influence is present?
You've hit on a significant connection explicitly addressed in the standards. Related parties can be used to facilitate fraud in various ways. For example, special purpose entities might be used to facilitate earnings management, perhaps by shifting revenues or expenses off the main company's books to obscure true performance. Or transactions with business partners or intermediaries connected to key management could be arranged to facilitate misappropriation of the entity's assets. End quote. If a related party exerts dominant influence over the entity or its management, perhaps due to dependency or lack of oversight, it significantly increases the opportunity for management override of controls and can indicate significant risk of material misstatement due to fraud. Red flags associated with dominant influence might include an unusually high turnover of senior management or professional advisors, perhaps because they question questionable transactions, the use of business intermediaries, for which there appears to be no clear business justification, like shell companies used for routing payments, or excessive participation by or preoccupation of non-financial management with the selection of accounting principles or the determination of significant estimates. These behaviors suggest an environment where normal checks and balances might be bypassed, facilitating fraud.
So once the auditor has navigated all of this complexity and risk, what are the final steps for related parties from a reporting and documentation perspective? What do they need to get and record?
The auditor must obtain written representations from management, and, where appropriate, from those charged with governance, confirming that they have disclosed to the auditor the identity of all related parties and all related party relationships and transactions of which they are aware, and that they have appropriately accounted for and disclosed such relationships and transactions in accordance with the requirements of the framework. Additionally, the auditor communicates significant matters arising during the audit in connection with related parties to those charged with governance. This ensures they are aware of the key findings and risks. Finally, the auditor shall include in the audit documentation the names of the identified related parties and the nature of the related party relationships. This meticulous documentation is essential for the audit file, supporting the procedures performed and conclusions reached, and demonstrating due diligence in this high-risk area.
Patterns and Trends Analytical Procedures, SA 520.
That deep dive into related parties really highlights the complexity auditors face, especially with that heightened risk of fraud. It's a tricky area. Now let's talk about SA 520, analytical procedures, which seems to be about spotting patterns, trends, and inconsistencies rather than just digging into individual transactions. What exactly are analytical procedures and why are they so important in modern auditing? Are they becoming more important?
Yeah, I'd say they are increasingly important, especially with data analytics tools becoming more common. Analytical procedures are formally defined as evaluations of financial information through analysis of plausible relationships among both financial and non-financial data. They also crucially involve the investigation of identified fluctuations or relationships that are inconsistent with other relevant information or that deviate significantly from predicted amounts. They are vital because, as you noted, routine checks of records and documents alone may not be adequate to reveal all mistakes, manipulations, or dominating trends. In modern auditing, where internal controls are heavily emphasized, analytical procedures are vital for gaining a holistic, high-level view and identifying areas that seem unusual or warrant deeper investigation. They're like using a wide-angle lens to look at the entire financial picture, not just focusing on individual pixels with a microscope.
Can you give us a quick illustration? The material had a good one about rent that really drove the point home for me, how they spot something unusual.
Certainly. That's a great example. Imagine you're auditing XYZ Ltd. and you're verifying their monthly rent payments of, say, $50,000. If you only perform a detailed check, test of detail, you'd likely vouch the payment to the rent agreement and the bank statement. Looks consistent, right? 50,000 paid, agreement says 50,000. No issue found. But if you apply analytical procedures and compare this rent expense to what other companies in the similar industry are paying for a similar location, perhaps using industry benchmarks or local real estate data, and find they typically pay only, say, $10,000 per month, you've immediately identified a significant inconsistency. This flags a potential misstatement, maybe an error in recording, or perhaps an unusual, maybe even related party transaction that requires investigation. A routine check focusing only on internal consistency would completely miss this anomaly. It's about spotting things that just don't look right in the broader context.
That's a powerful example. So it's really about context and comparison. And it's not just financial data compared to financial data, is it? It's about combining financial and non-financial information to gain insights, like employee numbers and wages.
Exactly. That combination is often very powerful. For instance, in the case of ABC Ltd's wages expense from your material, an auditor can combine financial data like average wages per worker with relevant non-financial data like the total number of workers across all the factories, obtained perhaps from HR records, to develop an independent expectation for the total wages paid for the period. Comparing this expectation to the recorded wage expense allows for a more comprehensive and plausible evaluation than just looking at the total wage expense in isolation or comparing it only to last year's total.
This sounds like a procedure that's useful throughout the audit, not just at one specific stage like testing. Is that true? Where do they fit in?
Yes, absolutely. Experienced auditors typically use analytical procedures at all stages of the audit. In the planning phase, they are used as risk assessment procedures to assist in understanding the client's business and in identifying areas of potential risk where material misstatements might occur. This helps the auditor determine the nature, timing, and extent of other more detailed audit procedures. For example, comparing non-financial data like square feet of selling space to reported sales figures across different stores can help identify stores with unusually low or high performance, flagging them for further attention. During the testing phase, they are used as substantive analytical procedures, either alone or in combination with tests of details, to obtain audit evidence about particular assertions and detect material misstatements directly at the assertion level. This is where you actually rely on them to reduce audit risk for specific account balances or transactions. And finally, in the overall review or completion phase, analytical procedures are used to assist the auditor when forming an overall conclusion as to whether the financial statements as a whole are consistent with the auditor's understanding of the entity and seem plausible given all the evidence gathered during the audit. It's a final check for reasonableness.
Okay, that makes sense. Planning, testing, and reviewing. Let's focus on substantive analytical procedures used during the testing phase. What factors does an auditor consider when deciding whether to use them instead of or alongside tests of details? They seem incredibly efficient, but are they always the best tool for the job?
They are powerful and often efficient, but definitely not a universal solution. The decision to use substantive analytical procedures depends on the auditor's professional judgment about their expected effectiveness and efficiency in reducing audit risk for a specific assertion to an acceptably low level compared to performing only tests of details. Key factors influencing this decision include suitability. Are analytical procedures well suited to the specific assertion being tested? Some assertions, like existence based on physical observation, aren't easily addressed by analytics. Reliability of data. Is the underlying data, both internal and external, used to develop expectations reliable? If the data is flawed, the analysis will be meaningless, garbage in, garbage out. Controls over data preparation are important here. Precision of expectation. Can the auditor develop an expectation that is precise enough to identify a material misstatement? A vague expectation won't catch much. Acceptable difference. What is the amount of difference between the expected value and the recorded value that can be accepted without further investigation?
Can you elaborate on some of those? Like, what makes data reliable or an expectation precise?
Sure. Reliability depends on the source, comparability, nature, and relevance of the information available. For example, budgets might be expectations but lack reliability if not well prepared. Industry data might be reliable but not comparable. Controls over data preparation are also key. Precision is affected by how accurately an amount can be predicted. For example, relationships involving income statement accounts over time tend to be more predictable than balance sheet accounts at a point in time. Relationships in stable environments are more predictable than volatile ones. And the level of data aggregation matters more disaggregated data, for example, by month, by product line, by location, generally allows for more precise expectations.
Okay, and you mentioned suitability for assertions. Which accounts or assertions are they generally better for?
Generally, analytical procedures are more useful for certain types of accounts than for others. Income statement accounts, which reflect predictable transactions accumulated over a period, e.g. revenue related to volume, cost of sales related to revenue, tend to be more suitable than balance sheet accounts, which represent balances at a single point in time or might involve greater management judgment, for example, provisions, fair value of complex financial instruments. They can be effective for assertions like completeness, for example, predicting rental income based on occupancy, or valuation, for example, checking depreciation reasonableness, but perhaps less so for rights and obligations or detailed existence testing where inspection or confirmation might be better. However, modern data analytics techniques are expanding their applicability.
And what about risk? If it's a really high-risk area, can you rely solely on analytical procedures?
Usually not for high-risk areas. When the inherent risk is higher, or for assertions requiring significant judgment, tests of details may be more appropriate, either instead of or in addition to analytical procedures. Importantly, audit evidence obtained solely from substantive analytical procedures is unlikely to be sufficient when responding to significant risks, especially those indicating potential fraud, such as complex revenue recognition schemes involving undisclosed site agreements. For those, you need more direct corroborating evidence, not just high-level analysis.
So they're powerful, especially for predictable accounts in lower risk areas, but they're not a silver bullet, particularly when fraud risk is high or significant judgment is involved. What are some specific techniques auditors use for these substantive analytical procedures? What do they actually do?
The main techniques auditors commonly use include trend analysis. This involves comparing current financial data to prior periods, often looking at trends over several years. Example, analyzing sales, cost of sales, or specific expenses like salary expense month over month or year over year. An unexpected break in a trend warrants investigation. Ratio analysis. This is comparing key financial ratios derived from current period data to benchmarks like prior periods, budgets, industry averages, or other similar entities. Examples include analyzing the gross profit ratio, trade receivables turnover days, or debt-to-equity ratio. Significant deviations from expectations or benchmarks need explanation. Reasonableness tests. Unlike trend analysis, which relies on past data, these tests do not rely on events of prior periods. Instead, they use operational or non-financial data from the current period to develop an independent expectation of an account balance or transaction total. Examples include using occupancy rates to estimate hotel rental income, using production volume to estimate raw material consumption, or using average interest rates to estimate interest expense on debt. These are often more applicable to income statement accounts. Structural modeling. This involves constructing more sophisticated statistical models, often using historical financial and operational data, to predict current account balances. For example, using regression analysis to predict sales based on advertising spend and economic indicators.
That gives a good flavor of the techniques.
Before you even apply these techniques, you must have some kind of expectation about what the numbers should look like. Right. And also decide how much of a difference you're willing to accept before you say, hang on, something's not right here. How does that work?
Precisely. Developing that expectation is the critical first step. The auditor must develop an expectation of recorded amounts or ratios based on their understanding of the client and industry, and then evaluate whether the expectation is sufficiently precise to identify a potential material misstatement. The more precise your expectation, the more effective the analytical procedure will be. Then the auditor must determine the amount of any difference of recorded amounts from expected values that is acceptable without further investigation. This threshold, often called the tolerable difference or investigation threshold, is influenced by materiality and the desired level of assurance, consistent with the planned reliance on the analytical procedure. A key point here is that the higher the assessed risk of material misstatement, the smaller the amount difference considered acceptable will need to be, because you need more persuasive evidence and have less tolerance for unexplained variations in high-risk areas.
Okay, so you set your expectation, set your acceptable difference. And what if the actual numbers fall outside that acceptable range? If inconsistencies or significant differences compared to your expectation are identified, what's the auditor's next step? You can't just flag it and move on, right?
No, absolutely not. Identifying a significant difference is just the start of the work. If fluctuations or relationships are identified that are inconsistent with other information, or if differences from expected values exceed that acceptable threshold, the auditor must investigate them. This investigation typically starts with 1. Inquiring of management to understand the reasons for the difference and obtaining appropriate audit evidence to corroborate management's responses. The auditor needs to evaluate these responses critically. Do they make sense? Are they supported by other evidence, or are they just hand-waving? 2. Performing other audit procedures as necessary in the circumstances if management's explanations are inadequate, non-existent, inconsistent with other evidence, or simply not persuasive. This could involve performing more detailed tests on the specific area or revising the initial risk assessment and modifying other planned audit procedures if the difference appears to indicate a potential misstatement. The goal is to resolve the difference satisfactorily.
Putting it all together, case studies and application.
Right. That investigation step is key. Okay, we've covered a huge amount of ground with the standards on auditing related to audit evidence. SA 500, 501, 505, 510, 530, 550, and just now 520. Now, the real test, and what you, our listener, are likely most interested in for your exam preparation, is how to apply all this knowledge. So we're going to walk through several case studies, straight from your source material, to see how these essays come to life in practical exam-style scenarios. This is really where the rubber meets the road, isn't it? Seeing it in action.
Exactly. This is where we bridge theory with practice. Remember, the goal isn't just to identify the correct answer in these scenarios, but to understand the why behind it, connecting it back to the essay principles we've just discussed, and really thinking like an auditor facing these situations.
Okay, let's start with case study 1, C.A. Kartik's selective examination. The scenario describes C.A. Kartik, an efficient auditor, who selected specific items for tests of details based on his judgment. He decided to verify all sales transactions above 25 lakhs, all fresh additions to property, plant, and equipment above 25 lakhs, and because he's suspicious, certain sales transactions totaling 50 lakhs near the year-end that had no e-way bills and went to a single customer. He also went through all related party transactions in detail. The key question here is, can this approach be construed as audit sampling as defined in SA 530, and what kind of risk is primarily involved with this approach?
This is a classic test of understanding the precise definition of audit sampling from SA 530 versus other selection methods. C.A. Kartik's approach here is clearly selective examination of specific items based on criteria like value or suspicion. It is not audit sampling. The reason is fundamental. The results of audit procedures applied to items selected in this judgmental way cannot be projected to the entire population, for example, to all sales or all PPE additions. This method does not provide audit evidence concerning the remainder of the population because not every item had a chance of selection. He specifically targeted certain items.
So he's essentially cherry-picking based on judgment or specific risk factors, which isn't random or representative in the SA 530 sense. What risk does that introduce, then, if it's not sampling risk?
Exactly. Because it's not sampling. It's not subject to sampling risk. Instead, such an approach is subject to non-sampling risk. This is the risk that the auditor reaches an erroneous conclusion for any reason not related to sampling risk. Examples include the use of inappropriate audit procedures, misinterpretation of audit evidence, or failure to recognize a misstatement or deviation.
It's about human error, flawed judgment in designing or performing the procedure, or bias, rather than the inherent uncertainty associated with testing only a subset of the population.
Okay, that distinction between sampling risk and non-sampling risk and what constitutes true audit sampling is really important. Let's move to case study 2. CA Tripty and export revenue. CA Tripty is auditing TK Home Private Limited, an export house. The internal audit staff tells her export sales are recognized based solely on bills of lading, but she's not convinced that's sufficient evidence for revenue recognition. She's verifying export revenues from invoices. The company exports goods after payment of IGST, which gets refunded after shipment. The question is, from what other sources can she obtain reliable audit evidence for export revenues, and how can she challenge management's assertion regarding the completeness of those revenues?
Right, this requires applying principles from SA 500 on reliability and types of evidence, maybe SA 520 on using financial and non-financial data, and understanding the business context. CA Tripty is right to be skeptical of reliance solely on bills of lading for revenue recognition. While external, they primarily prove shipment, not necessarily meeting all revenue recognition criteria depending on the Incoterms. She can obtain more reliable audit evidence by going through GST returns filed by the company on the GST portal and correlating the same with e-way bills. GST returns are external documents filed with regulatory authorities, subject to oversight, making them generally reliable. E-way bills, which legally confirm the movement of goods for GST purposes, further corroborate the transaction's occurrence and timing. To challenge the completeness assertion ensuring all revenue that should be recorded is recorded, she can verify how these specific airport sales are reflected in the official GST returns, or all the sales she expects to see actually reported there. Furthermore, the IGST refund mechanism is directly linked to the filing of shipping bills and monthly sales returns, like GSTR1, GST, or 3B. She can verify this linkage. Have refunds been claimed for all recorded export sales? Have sales been recorded for all refunds claimed? This cross-verification using regulatory filings helps ensure completeness.
That's a great practical example, bringing in external regulatory data, which is powerful evidence, and showing the interplay of different evidence types to hit different assertions. Okay, next, case study 3, CA Sunitha and legal expenses. CA Sunitha, during her audit, finds a payment of 10 lakhs to a lawyer named B. George. Management gives evasive replies when she asks about the nature of this expense. Concerned, she decides to correspond directly with the lawyer herself, sending an inquiry letter on her audit firm's letterhead, asking for details on any litigation or claims involving the company. The questions are, is her approach of sending the letter on her letterhead proper? And what is she fundamentally trying to achieve by seeking this direct communication?
Okay, this scenario directly tests the procedures outlined in SA 501 regarding litigation and claims, specifically the appropriate method for external communication with legal counsel. Her approach of preparing and sending the inquiry letter directly on her firm's letterhead is improper. As per SA 501, the standard procedure is that the letter of general inquiry has to be prepared by management and sent by the auditor. This is crucial because it ensures that management explicitly authorizes the communication with their legal counsel, acknowledging that the auditor is seeking potentially privileged information. She also generally needs to inform management of her intention to communicate directly with the lawyer before sending the letter prepared by them.
Okay, so it's a procedural error in how she initiated the contact. But putting that aside, what's her underlying objective in wanting to contact the lawyer directly in the first place, especially given the evasive replies? What's she trying to find out?
Her purpose in wanting to correspond directly with the lawyer, despite the procedural misstep, is clearly driven by the need to identify litigation and claims involving the entity which may give rise to a risk of material misstatement. Given the large payment and management's evasiveness, she is concerned about potential undisclosed liabilities or contingencies. She's trying to achieve completeness regarding litigation and claims, ensuring that any significant legal matters that could have a material effect on the financial statements and thus may be required to be disclosed or accounted for under the applicable financial reporting framework are identified and properly considered by management and reflected in the financials. The evasiveness flags it as a risk area needing direct corroboration.
Understood. The why is right, but the how was wrong. Okay, next up, case study 4. CA Tanmaya and inventory with third party. TS Ltd has a substantial amount of inventory lying with a third party, Super Industries, for finishing work. CA Tanmaya had planned, reasonably, to obtain confirmation from Super Industries regarding this inventory. However, just before the audit fieldwork begins, Super Industries' premises are raided by the Directorate General of GST Intelligence, DGGI, for involvement in a fake billing scam, and the proprietor is arrested. How should CA Tanmaya proceed now regarding the inventory held by super industries? Just sending a confirmation seems, well, pretty pointless or even risky now, right? Yeah.
Absolutely. This scenario combines SA 501, inventory held by third parties, and SA 505, external confirmations, but layers on a critical element of professional skepticism and assessing evidence reliability, potentially touching on fraud risk implications, SA 240 context. The raid and arrest cast significant doubt on the integrity of super industries, and therefore on the reliability of any confirmation that might be received from them. The reliability of evidence from an independent external source is severely compromised if that source is known to be involved in fraudulent activities. Therefore, merely seeking or relying on a confirmation from super industries would be insufficient and provide little to no persuasive audit evidence.
So she needs much more robust alternative evidence given the circumstances. What would that look like in practice? What else can she do?
Exactly. She needs to pivot to alternative procedures that don't rely on super industries' representations. While she might still send the confirmation request as documentation of attempt, she cannot rely on the response, if any. Instead, she should perform rigorous alternative procedures, such as 1. If feasible and appropriate, arranging to attend the third party's physical counting of the inventory at super industries premises, or if that's not possible or safe, perhaps arranging for some other auditor to attend the physical counting on the reporting date on her behalf. Direct observation is key here. 2. Performing detailed procedures on the entity's own records. Inspect the record of goods sent to super industries and received back from them, meticulously tracing quantities to supporting documentation like dispatch challenges, goods receipt notes, and importantly, related e-way bills to verify the physical movement of goods. 3. Attempting to correlate the information obtained from the above procedures, the physical count observation, if possible, the entity's internal records, and the goods movement documentation to build a comprehensive and corroborated picture of the inventory's existence and quantity. This emphasizes the principle from SA 505. When confirmation reliability is in doubt, the auditor must seek further or alternative evidence to obtain sufficient appropriate audit evidence.
Okay, that makes complete sense. Adapt the procedures to the heightened risk. Now this next one, case study. Related party transactions and fraud Living Well Private Limited and My Living Private Limited looks like a big one, integrating SA 550 on related parties and SA 240 on fraud risks. This feels like a potential exam centerpiece. We have two related companies, Living Well and My Living, with common directors. One director, Mr. Burrows Lal, is also MD of Trustworthy Real Estate Private Limited. The case states he's in personal financial difficulty, has an expensive lifestyle, a dominant personality, there's poor governance in his company, and he's apparently influenced a foreign partner of a special purpose vehicle, SPV, Real Trust Developers, through favors. There are two key transactions mentioned. My Living sells 1 crore machinery to Living Well, supposedly at normal market rates. Separately, the SPV, Real Trust Developers, paid 20 crores to an entity called Mrs. Useless and Sons, PLTD, and almost immediately after, Mr. Burrows Lal infused 5 crores as his equity contribution into the SPV. CA Skeptic, the auditor, suspects a link between these SPV transactions and potential misappropriation of funds by Mr. Burrows Lal. We need to guide CA Skeptic in identifying the fraud risks, establishing the suspected link, and planning future actions. This is complex.
This is indeed a complex, high-stakes scenario packed with red flags, demanding significant professional skepticism and a thorough application of SA 550 and SA 240. It's exactly the kind of integrated case study you might face. Let's break it down. First, let's identify the fraud risk factors present here, using the fraud triangle framework. Incentive pressure, opportunity, rationalization, from SA 240. Incentive pressure. Mr. Burrows Lal has clear personal financial difficulty and mounting dues, coupled with an expensive lifestyle. There's also the specific requirement to fund 5 crore as equity contribution in the SPV. These create strong personal pressures that could motivate fraudulent behavior to obtain funds. Opportunity. Several factors provide opportunity. There's the apparent vulnerability and dependence of the foreign partner in the SPV due to their lack of local law knowledge and understanding of the SRA business model, making them susceptible to influence or manipulation by Mr. Burrows Lal. The described poor governance structure, where Mr. Burrows Lal dictated the decisions, creates an environment ripe for management override of controls.
The nature of the real estate industry and SRA business model itself can involve complex transactions, significant judgments, and potentially opaque SPVs, providing inherent opportunities for structuring manipulative transactions. The related party relationship itself provides opportunity. Rationalization attitude. While not explicitly stated as a rationalization, his dominant personality and powerful influence, combined with providing favors to influence the partner, might suggest an attitude where he believes he is entitled or that the rules don't apply to him, allowing him to rationalize unethical actions. Specific red flags. The sequence of the 20 crore payment by the SPV to Mrs. Useless and Sons, PATD, followed almost immediately by Mr. Burrows Lal's 5 crore equity contribution into the SPV, strongly suggests a potential link and a circular flow of funds designed to siphon money out and then back in as equity. The favors provided to the foreign partner also indicate attempts to exert undue influence and potentially override normal decision-making or controls.
The 1 crore machinery transaction between related parties also needs scrutiny regarding its arm's-length nature, though the SPV transactions seem like the bigger fraud risk here.
Okay, the fraud risk factors are certainly screaming out here. So, how does CA Skeptic go about rigorously investigating and trying to establish the suspected link between the 20 crore payment out and the 5 crore equity infusion in? What procedures under SA 550 and SA 240 should the team perform? It sounds like they need to go beyond standard procedures.
Absolutely. This situation demands going well beyond standard related party procedures. The investigation needs to be meticulous and skeptical. 1. Engagement team discussion. First step, as per SA 315 and SA 240, is a mandatory discussion among the engagement team focusing specifically on the susceptibility of the entity's financial statements to material misstatement due to fraud or error that could result from the entity's related party relationships and transactions, particularly concerning the SPV and Mr. Burrows Lal's influence and financial pressure. Brainstorming how fraud could occur here is key. 2. Heightened professional skepticism. CA Skeptic and the team must maintain significant professional skepticism throughout the audit, constantly questioning management's assertions and seeking corroborating evidence, especially regarding the purpose and substance of the SPV transactions and the nature of the relationship with Mrs. Useless and Sons, PLTD3. Understanding and identifying related parties. Independently verify the nature and extent of the entity's relationships and transactions with all related parties, including potentially undisclosed ones. This involves reviewing MBP1 data management beneficial ownership declarations and data available on the MCA Ministry of Corporate Affairs website relating to directors and companies. To identify connections that management might not have disclosed, possibly linking Mr. Burrows Lal or his family associates to Ms. Useless and Sons, PLTD. Consider circumstances that might indicate previously unidentified relationships, like the complex SPV structure or inadequate information systems potentially obscuring links. 4. Considering how related parties facilitate fraud. The team needs to specifically consider how related parties might be involved in fraud in this context. Examples given in the standards include using special-purpose entities to facilitate earnings management or arranging transactions with known business partners to facilitate misappropriation of the entity's assets. This framework directly applies to the suspected scheme involving the SPV, Mrs. Useless and Sons, PLTD, and Mr. Burrows Lal.
So those are the overarching considerations. What specific additional audit procedures does CA Skeptic's team need to undertake now to try and confirm or refute this suspected link and potential misappropriation? What evidence should they gather?
Given the strong red flags and suspicion of fraud, the team needs to perform targeted and potentially forensic-style procedures. They must perform detailed verification and inspection of the ownership structure and the review of the financial statements of the Mrs. Useless and Sons, PLTD, through the MCA website or similar corporate registry to try and establish the nexus, the connection between this entity and Mr. Burrows Lal or his known related parties or business associates. Who owns this company? What does it do? Does it seem legitimate? They should carry out an inspection of the data filed by Mr. Burrows Lal for his group companies like Trustworthy Real Estate to identify any past transactions or relationships between the two entities, the SPV group companies and Mrs. Useless and Sons, that might reveal a pattern or connection. Crucially, they need to ask for all the documents supporting the utilization of the INR 20 crore paid by the SPE to Mrs. Useless and Sons, PLTD. What was this payment supposedly for? Is there a contract? Are there deliverables? They must scrutinize the purpose, authorization, and legitimacy of this large payment.
Where possible and appropriate, they should attempt to investigate by visiting the parties involved and asking for confirmation directly, seeking independent evidence for the legitimacy and substance of these transactions. This might involve trying to contact Ms. Useless and Sons, PLTD, if possible and safe, and potentially having frank discussions with a foreign partner of the SPV, perhaps separately from Mr. Burrows Lal, to understand their perspective and the nature of the favors.
Okay, those are some serious investigative steps. And if, after all these rigorous procedures, it is established that there is indeed a likelihood of misappropriation of funds and that the financial statements are materially misstated as a result, What then? What's the future course of action for CA Skeptic? This has huge implications for the audit report and the auditor's responsibilities.
Yes, if the investigation confirms a likely misappropriation and material misstatement due to fraud, CA Skeptic needs to plan the next steps very carefully, considering both audit reporting and professional legal responsibilities. 1. First, they must reassess the reliability of evidence previously obtained. If management, specifically Mr. Baroslal, appears to have intentionally concealed related parties or facilitated fraudulent transactions, serious doubts arise about the completeness and truthfulness of representations made by management on other matters, and about the genuineness of accounting records and documentation provided throughout the audit. This might necessitate revising the entire audit approach and performing more extensive procedures elsewhere. 2. Second, they need to evaluate the implications for the auditor's report under SA 705. A material misstatement due to fraud would require at least a qualified opinion, or potentially an adverse opinion if the misstatement is pervasive. 3. Third, they need to determine the professional and legal responsibilities applicable in the circumstances, including communication requirements. This involves communicating the findings to the appropriate level of management and, importantly, to those charged with governance, like the audit committee or board. Depending on the jurisdiction and the nature of the entity, there might also be a requirement for the auditor to report the occurrence to regulatory and enforcement authorities. This directly ties back to SA 240's guidance when management fraud is identified or suspected, and the need to consider reporting obligations beyond just the audit report itself. Withdrawing from the engagement might also be considered if management's integrity is fundamentally compromised.
That's a comprehensive response to a very tricky, high-stakes situation, showing the real gravity and consequences involved when fraud intersects with related parties. Let's move to another integrated scenario, Fashion Jingo Ltd. This one seems structured more like a series of multiple-choice questions or short scenarios covering external confirmations, legal claims, and written representations. This feels very exam-focused.
Yes, this scenario is set up like a rapid-fire test of applying specific SA rules. Let's tackle each part. Part 1. Fashion Jingo Ltd. External Confirmation Non-Response. CA Anu sent a positive confirmation request to a customer of Fashion Jingo Ltd., but the customer has not responded. The question asks for the proper course of action. The correct response, based on SA 505, is to perform alternative audit procedures. Because it was a positive confirmation, a response was required. The non-response means no evidence was obtained from the confirmation itself, so alternative procedures, like examining subsequent cash receipts, shipping documents, underlying orders related to the receivable, are necessary to obtain sufficient appropriate evidence about the existence and valuation of that receivable. It's not treated as a negative confirmation where silence might imply agreement under specific conditions. Part 2. Advocate Chadha. Litigation and claims refusal. The company's external legal counsel, Advocate Mr. Chadha, refuses to comment on the likely outcome of a lawsuit filed by Mr. X against the company. CA Anu is unable to obtain sufficient appropriate audit evidence through alternative procedures. Perhaps management can't provide reliable estimates either. What should she do? In this situation, where sufficient appropriate evidence concerning a potentially material matter cannot be obtained, CA Anu should modify her audit opinion. This constitutes a scope limitation imposed by circumstances, leading to either a qualified opinion or a disclaimer of opinion under SA 705, depending on the potential pervasiveness of the effect on the financial statements. She cannot simply issue an unqualified opinion or just withdraw without reporting the issue. Part 3. Woolen PVT Ltd. Management refusal to confirm. Management of Woolen PVT Ltd. asks CA Anu not to send a confirmation request for a specific trade payable balance, citing that their business relations with the supplier are precariously placed and the request might jeopardize them. What should be CA Anu's first response? Before jumping to conclusions or modifying the opinion, the mandatory first step under SA 505 is to inquire as to the reasons behind the management's response and seek audit evidence as to their validity and reasonableness. She needs to understand why management is making this request and evaluate if the reason is legitimate and supported by evidence. Only after this inquiry can she evaluate the implications for risk assessment, perform alternative procedures, and consider modifying the opinion if necessary. Part 4. Mr. X case. Legal claims procedures. The engagement team is designing procedures to identify litigation and claims against their client related to the Mr. X case mentioned earlier. The question asks which procedure will not typically be performed as part of identifying litigation against the company. The answer is inquiry of Mr. X, the opposing party, directly by the auditor.
Standard audit procedures, SA 501, to identify litigation include inquiry of management and the entity's in-house or external legal counsel, reviewing minutes and reviewing legal expenses. Auditors do not typically contact the opposing parties in lawsuits directly as part of their standard procedures to identify claims against their client.
That's a great way to show how the specific rules directly translate into required audit actions or judgments in different situations. Very practical. Let's do one more to really solidify the link between actions and theory. Case study. C.A. Manouchi and financial statement assertions. C.A. Manouchi is planning several verification procedures for her audit. 1. Checking major bills booked under the machinery repair expense account for correctness and proper classification. 2. Verifying the genuineness of trade payables balances. 3. Comparing current year wages with the last year and verifying the relationship between total wages paid and the number of employees. 4. Examining title deeds for land recorded in the balance sheet. 5. Verifying whether the conversion of foreign currency transactions into Indian rupees is proper or not. Let's identify the type of audit procedure being performed or the primary financial statement assertion being addressed by each of these planned actions.
Okay, this case study perfectly links specific common audit actions to the underlying audit procedure type from SA 500's list and the financial statement assertions they are primarily designed to address. This connection is fundamental to planning effective audits. 1. Machinery repair bills. When C.A. Manouchi plans to verify major bills in machinery repair for correctness, amount, and proper classification, ensuring they are indeed repairs and not capitalizable assets, she intends to perform tests of details on transactions. Specifically, she's addressing the accuracy, amounts recorded appropriately, and classification recorded in the proper accounts, assertions related to classes of transactions and events. 2. Her plan to compare current year wages with the last year, and crucially, verify the relationship between total wages paid and the number of employees, is a clear example of substantive analytical procedures. Specifically, a reasonableness test using non-financial data and trend analysis. This procedure can provide evidence about the overall reasonableness, accuracy, valuation, allocation, and potentially completeness of the wage expense. 4. Title deeds for land. Examining title deeds for land recorded as an asset is a classic inspection audit procedure, inspecting tangible assets or documents. This procedure directly relates to verifying the existence assertion. Does the land represented by the deed physically exist, or is the deed valid? And very importantly, the rights and obligations assertion. Does the company legally hold the rights title to this land? 5. Foreign currency conversion. Her intention to verify whether the conversion of foreign currency transactions or balances into Indian rupees is proper or not is primarily a recalculation procedure. She's checking the mathematical accuracy of applying the correct exchange rates according to the accounting standards. This directly addresses the accuracy, valuation, and allocation assertion.
That's a perfect illustration. Seeing how specific everyday audit actions like looking at a title deed or checking a calculation are designed to address particular financial statement assertions using the specific types of audit procedures defined in SA 500. It really brings all the essays we discussed to life for someone preparing for an exam. It connects the dots beautifully. Outro. Wow, what a deep dive that was. We started by addressing that feeling of information overload, maybe facing a tough exam topic. And I think it's safe to say we've achieved our mission today for you. We've thoroughly unpacked audit evidence from pretty much every angle, covering those crucial standards on auditing SA 500, 501, 505, 510, 530, 550, and SA 520 on analytical procedures. More importantly, I think we've seen how these concepts actually apply in practical exam-style scenarios, just as you might encounter them, hopefully providing you with that comprehensive application-based understanding you were looking for.
We really did drill down into the details, didn't we? From understanding the core definition of audit evidence and its cumulative nature to dissecting the critical concepts of sufficiency and appropriateness. That balance is just so key. We explored the nuances of reliability, internal versus external sources, the impact of controls, direct versus indirect evidence, and we went through that whole toolkit of audit procedures: inspection, observation, confirmation, recalculation, reperformance, analytical procedures, and inquiry. We also paid special attention to those specific items like inventory and litigation in SA 501, the intricacies of external confirmations in SA 505, the unique challenges of initial audit engagements in SA 510, the science and art of audit sampling in SA 530, and that really high-risk area of related party transactions in SA 550, especially how it links to fraud risk under SA 240.
Yeah, absolutely. For you, our dedicated learner, the key takeaways from this deep dive are, I think, profound. Remember that constant interplay between sufficiency and appropriateness quantity doesn't compensate for poor quality, ever. Quality is king. Always critically consider the source and nature of evidence to assess its reliability. Don't just accept things at face value. And perhaps most importantly, grasp that the concept of risk, whether it's sampling risk, non-sampling risk, inherent risk, control risk, or fraud risk, underpins all audit procedures. Audit is about obtaining reasonable assurance, not absolute certainty. It's about building a solid, persuasive case based on sufficient, appropriate evidence, not achieving an impossible perfection.
And, beyond the exam, understanding audit evidence is really about developing a truly critical mindset for any information you encounter. It's about not just accepting data, but instinctively asking, is this information relevant to my decision? Is it reliable, given its source and context? Is there enough of it? Is it persuasive? These are questions and skills that will serve you far beyond auditing financial statements, really, in every aspect of your professional and even personal life where you need to evaluate information.
Indeed. That's a great point. So as you move forward from this deep dive, maybe consider this. In our world, which is just increasingly flooded with data where information comes from countless sources and claims fly freely online and everywhere else, how might these fundamental principles of audit evidence, assessing relevance, assessing reliability, ensuring sufficiency extend beyond just financial statements? How can they help you evaluate the truth and trustworthiness of any information you encounter day to day?
Yeah, it's a powerful framework for thinking critically. We definitely encourage you to review your notes, maybe revisit some of those complex case studies we discussed today, especially the related party fraud one, and challenge yourself to apply these concepts in your own thinking and studies.
And whenever you need another shortcut to being truly well-informed on a complex topic, you know where to find us. Join us next time for another deep dive.